King and Larry Fulton. GJ King is an entrepreneur, an ETA entrepreneur, and partner at BK Growth Partner Investing in ETA entrepreneurs, as well as a professor of ETA at the Weatherhead School of Management. Larry Fulton is the founder of Fulton Equity and an ETA entrepreneur, Weatherhead School alumnus, and mentor at Promise Partners ETA Accelerator. Let's give them a warm welcome.
See, can you hear me? Great. Thank you so much for being here. I know Larry and I are excited to kind of talk through a few things today. For quick flow, I think we're going to plan on maybe spend about 30 minutes kind of comparing and contrasting a little bit of kind of our different investment styles, kind of hitting a few different things. We do have a few slides, and then maybe leave the last 10 to 15 minutes or so for Q&A if that works for everyone. So maybe I can share just some of the types of, where I spend a lot of my time investing, and then Larry can do the same, and then we'll maybe, shift to slides here for a bit and kind of yin and yang a bit. Just for a little more context, I personally did what we call a traditional search fund, which we could spend probably a whole session on, where ultimately we acquired a small business, and then with my business partner led that business together for about 10 years with an outside group of investors. Subsequently, and kind of towards the end of that journey, my business partner and I started investing quite extensively in search funds ourselves from the investor side. So we're invested in probably about 50 small businesses, ranging in size from maybe $1 million of enterprise value to a few $100 million in enterprise value. We've been doing that for quite some time now. And then we're probably, over the years, invested in over 100 search funders at the search stage looking for a business to acquire. So it's run the gamut, primarily in the United States, a little bit internationally. But that's kind of one form of ETA, which maybe, Larry, you can maybe chime in a bit about how you've kind of spent your time investing and operating.
Oh yeah, completely different type of investing. Think lower middle market, industrials type businesses. And so back in 2003, my first acquisition was a pallet company, so a wood pallet business. We made high volume pallets. It was actually located in Middlefield, Ohio. And then in 2005, my second acquisition was a wood crating business. So think of a very niche, it's not a pallet. I used to joke around that I could sell a full truckload of 48 by 40 pallets and make $700 of profit on a full load, right? So we were cranking out a lot of loads of pallets. But think crating, I could sell 5 crates and make $2,000 worth of profit at the end of the day. So very niche, very customized manufacturing. Later on, I did a joint venture with a company called Worthington Industries down in Columbus, Ohio, where we were making steel racks. So I went from the pallet business to the wood crating business to the steel rack business. And then later on, I did yet another acquisition where I bought a wood products business as a bolt-on to my original wood products business. And that made steel wood containers and wood guitar racks that sold into like Sam Ash and those types of retailers as well. And also I did a fiberglass manufacturing acquisition that I still run today. And fortunately, last year we had an exit of our wood products business, and I'm constantly on the hunt. So I'm actually under LOI with a completely different type of business, which is a B2C, a retail brick and mortar business. So I've invested from distribution, manufacturing, light assembly, heavier manufacturing, and also retail.
Super helpful context, and maybe we'll stand a little bit here just as we talk about a few more details. But I think one interesting thing to kind of note there is obviously very different backgrounds. I ran a regulatory compliance software business for investment advisors. I do not know a lot about wood pallets, but I think you're going to see there's a lot of commonality and similarities of how we think about investing, but also some contrasts as well. And I also think you're going to, as we talk through the session a little bit, not every investor is the same, and when you're thinking about the types of deals you're looking at, the things you're thinking about approaching, what I may love, Larry may hate, and what Larry may love, I may hate. Doesn't mean one's right or wrong. It's just there's going to be different preferences as you think about investors. So, so I stand back here, you can see a little bit. I won't spend much time on this, just to set the stage. We're going to talk a little about just like the very basics of investment, of kind of like risk return, because I think it does kind of help kind of think through some of the topics we're going to talk through today. So, big picture. This is a study that Stanford does every 2 years. This is kind of the traditional search fund kind of model that I was talking about early on. You don't need to read through all this. The punchline is, search funds historically have returned a very attractive investment return. And we could talk through why that is that sustainable going forward or not? But roughly speaking, it's been about a 35%, IRR, which is kind of like best-in-class investment returns. Now, to set a little more context, though, sometimes just taking a step back on investing of like what are investors thinking about when you're investing in any asset class, for lack of a better kind of word or phrase. If you approach Larry with an opportunity to invest in a local, manufacturing business, and you say, "Hey, I think over 5 years this is going to generate a 5% return," I mean, Larry, how would you react to that? Like if someone said, "Hey, this is a great business. I'm really excited about it, but I think if things go well, it's probably a 5% kind of annual return." Like, any reactions?
Oh yeah, absolutely. I mean, easily you can go into the broader market and get that with a mutual fund and have full liquidity, right? So why take that risk? Why take that burden of responsibility if the return is not really going to justify the risk?
Yeah, so for context, investing in, leading, operating small businesses is risky. There's just no way around that. And through experience and best practices and pattern recognition, there are ways to minimize, and minimize is a strong word, ways to kind of reduce that risk. But this is a risky thing when you're approaching this from an investor standpoint, from a leadership standpoint, from an operator standpoint. This is risky. So, in our world, often, we are looking for, when we're investing, roughly like a 35% target return, which, by the way, is really hard. Like, if you think about it, almost every other investor in the world is willing to, accept a lower return. So in our world, if you start, seeing a search fund, searcher looking at larger businesses, maybe more in the realm of 4, 5, 6 million of EBITDA, all of a sudden they often start bumping into a private equity firm. And private equity is candidly solving for often a lower return, where they may be very excited to have a 20, 25% return. So if two investors are looking at the same transaction, one is willing to accept a lower return, they're generally willing to pay more, they're willing to take, so it changes that whole dynamic. So when you're thinking about these deals, really have to understand kind of who are you talking to, because if someone approaches us as an investor and says, "Hey, this is a great opportunity, it's about a 15 to 20% return," I'd say, well, I probably could just invest in a middle market private equity fund with experienced management teams, a long track record. It's not going to be as fun or exciting, but it's probably going to generate a similar return, candidly probably with lower risk, because investing in a single business like this is going to be quite risky. So, we just want to kind of set the stage. I think every investor may be thinking about things a bit differently of kind of what their availability is of different investments, but you have to kind of put yourself in the investor's shoes of what are they considering as other options when you're approaching them with a potential investment. Maybe, Larry, can you kind of talk through kind of some of the things you think about? And again, we could spend, hours on these details,
Yeah,
but just,
absolutely.
Big picture, like how are you thinking about kind of those risk and return considerations personally?
Yeah, I think that is a really good question in terms of how do you look at risk and return, right? I break it down into 3 different buckets. The first bucket really is what kind of anticipated return will I get if I look at a particular business. And the second bucket really is around risk assessments. What's the key risk identifiers of an investment that I need to worry about? And then third is I'm doing a base, best, and worst case scenario when I do my analytics around proving the return on that investment, right? And then I'm looking at, obviously, some mitigating factors. So in terms of the first bucket, I typically start off with multiple arbitrage. What value can I bring to a particular business to really get the valuation at the end of the day when I get ready to sell that business? What's the arbitrage? That's the difference between the purchase price or the original multiple that I buy a business at and what I believe I can potentially sell it, and all the value that can be created during that whole period, right? Now, conservatively, I don't go in and thinking, oh yeah, I'm gonna buy this business for 3 and I'm gonna sell it for 6. It doesn't necessarily work that way. So to be very conservative, I use multiple arbitrage in a scenario where I know that there's significant value, either through technology advancement or disruption or something else, some significant advantage that I can bring to that business, right?
And Larry, just to interrupt you for a second, like if you go back to this slide, like a huge driver of these returns is multiple arbitrage, right? If you think about buying a smaller business, professionalizing it, scaling it, I think there was another session just before this down the hall talking about larger businesses sell for, higher prices for a number of reasons. If you can buy a small business with $1 million, $2 million of EBITDA, professionalize it, de-risk it, ultimately grow that to $5, $10 million of EBITDA, all things equal, it's generally going to sell for a higher price.
Yeah, to that point, because companies traditionally trade in a particular range. So you have very small businesses, you have lower middle market, and so those types of businesses might trade in the 4, 5, 6 multiple range. You might have a middle market size business, which is traditionally around 25 to 50 to $75 million. Those would trade a little higher, probably the 6, 7, 8 times multiple. Then you have upper middle market and large companies, and those can be trading up to 10, 12, 14 times cash flow. So if you understand the value that you can create from an EBITDA perspective, you know where you're trading in that range and what you can potentially sell the business at. The other aspects in terms of potential returns is I'm looking at revenue growth, how scalability, how I can scale the business. I'm also looking at profitability, EBITDA improvement, right? And also I look at the components of EBITDA. Is it a lot of EBIT, or am I looking at depreciation and amortization? But I'm always, under every scenario, looking at EBITDA after capital expenditures, okay? What's my true cash? And then obviously, what's my exit strategy, right? Under the risk assessment, revenue concentration, revenue quality, how am I getting paid, cyclicality, things like that. Macroeconomic factors. I think a lot of people kind of miss that. But what are the macro or the geopolitical factors that are happening that might impact supply chain? That's a big conversation topic that a lot of economists talk about, right? Interest rates, unemployment figures, all of those characteristics, I think that kind of drives the risk assessment. And then when you're looking at the scenario analysis, how's the financials? And that anticipates the question is, yes, you have to get accurate financials, the historical financials of a business. The balance sheet has to be intact, the P&L has to be accurate, and then you can do a proper assessment of the risks, and then obviously being in a position where you can mitigate some of those risks that you identified.
And I'm sure it's easy to find great financial information for these businesses, right? I mean, is that often the case?
I could tell you some stories real quickly. One time I was buying a company, I won't give any clues, and I literally had to recreate the P&L, okay? And it was a task. I thought it was worth it at the time. I wouldn't do that now, but I recreated the P&L using receipts in a box. And so I wouldn't suggest that. That was a lot of work, but sometimes it could be grueling. But I would say for a lot of middle market, lower middle market firms, you got to get accurate balance sheet, P&L data so that you can do a proper assessment.
On that note, I was actually just catching up with a searcher we've been fortunate enough to back who is here today, he lives locally, and he had just got off, I think, an exercise yesterday of basically rebuilding the financials for an opportunity they're excited about, and basically had to recreate the entire P&L. So that exercise is actually quite common. And I think sometimes there's a danger of I'm going to outsource this, and yes, there are third parties that can help with that, but there's a lot you're going to want to do yourself because ultimately you're kind of making this investment for a lot of different reasons. The other consideration, of course, we talked a lot about kind of company characteristics. We'll talk about industry here in a few slides. Of course, the other thing we're often thinking about is the leadership, the operator. In our world, we call the searcher CEO. And I think there may be some, by the way, there is no right or wrong on this, and you may even hear some different philosophies from the two of us on this. But in our world, we're often backing someone, not exclusively, but often someone who's right out of business school. Generally has done not much in life. That was me, come out of business school. We had a group of investors. I had not done much at all. And what we've learned in our world is there's kind of a sweet spot, again, in the type of investing and types of situations we're involved with, where the people that have generally succeeded are often very fresh out of business school. And why they succeed is because they're just scared and they know they don't know anything. And they ask lots of questions, they seek help, they seek mentorship. They know they don't have the playbook, and they're just desperately seeking out that knowledge from others. On the other extreme, which this chart tries to show, it's more of a smiley face. It was a poor attempt. You can see I generally don't do a lot of PowerPoint. You have the kind of super seasoned entrepreneur who's done this a bunch of times. This is their third or fourth rodeo. They've got their playbook. They kind of know how to do this. They've made a lot of mistakes, and they come in and they're ready to go. That profile can often work very well. The danger zone we sometimes see in our world is that person who's kind of a few years out of business school, maybe has had some early career success, or even has done one deal before. There's like, in our world, often the second time someone does this, it's a massive failure because the first one goes well and you think you're just going to apply that same playbook. It turns out there's a lot of luck and chance involved in this. And it's that danger zone where someone thinks they have all the answers in the playbook, but they actually don't. And that's something that we're always trying to kind of suss out with this investor, kind of as you know, looking at entrepreneurs is this someone who kind of has the playbook? And yes, honestly, they probably do know what they're doing, and we need to kind of stay out of the way. Or is this someone that is super hungry, ambitious, seeking help, knows they don't know the playbook, but they will eventually get there through that process? Or is this someone maybe a little more in that danger zone? I don't know, Larry, if you have any kind of reactions to kind of how you think about this too.
Yeah, absolutely. So the ideal entrepreneur, in my opinion, I broke this up again into 3 different buckets. I look at character, heavily weighted on experience, and then obviously their education is third. On the character side, the first thing I'd say is grit. Now, let me step back. Honesty, integrity, leading with those basic characteristics, extremely important. My assumption is that entrepreneur has that, right? But the grit, the grind, do you have what it takes? Do you have fortitude? Because you're going to be inundated with situations where you have to think your way out. It's not just going to be all roses and cherry blossoms. It's difficult running a business because you have people, you have technology, you have equipment, you have moving parts that you are faced with every single day. Are you adaptable? Are you able to have a vision and then execute that? And then moreover, are you internally motivated as an individual, as a person? Or do I, as the owner, have to continuously push you to get stuff done, right? Under the experience category, what I really look for is direct industry experience. Have you run a business? Have you had experience with human resources, managing people, firing people, hiring a team, building a team, motivating a team, communicating that passion, the vision, the strategy, right? There's a lot of different aspects in terms of experience. Another one, a key takeaway I would say is the P&L. Are you someone who are shy away from numbers? Are you someone who really engage numbers? Because if you can really analyze numbers, they tell a story of the movement in a business, right? Then last, education. So that there's no prerequisite in terms of the amount of education that you have to have. But we do look at business and financial acumen, being a strategic thinker, looking at constantly having that learning mindset. Because if you're running an operation, right, and one of the things that you'll have to identify is what type of operation, how large the operation, et cetera. But if you're running an operation, you're going to have individuals that report to you. You're responsible for those individuals, right? And as your responsibility lies, so lies the success of the enterprise and all those individuals that you're responsible for. So having that learning mindset, I think, is extremely important.
Yeah, I think for us, I would just double click on humility, grit, and learning mindset. If you force us to kind of what we look for and what we've seen succeed, those 3 tend to take you pretty far. There's obviously some exceptions to that, but if you force me to kind of try to identify the 3 characteristics, I would echo a lot of what Larry said there as well.
I think one thing that really stands important to me is winning, being a winner. And that's not to say that you have to win all the time, but I think if you're growing up through life and you have winning circumstances, you're used to winning, right? More than likely, you're going to find a way to win. Even though you're going to have hardships and issues that are going to come throughout business, you're going to figure it out. You're going to be engaging. You're going to ask for advisors or engage advisors and just figure out how to make the solution happen. So that, to me, I think is very important.
Shifting course a little bit, we could spend a whole session or multiple sessions on what makes a good company. And as Larry and I were kind of thinking about this a little beforehand, we thought maybe just thinking about, lack of a better word or phrase, quality of revenue is a great starting point. And just maybe to kind of introduce that concept for those less familiar kind of in today's session. So how we think about, in the seat we sit with my business partner is this quality of revenue, or revenue quality is like paramount when we're looking at a business. And we have been fortunate to spend a lot of our kind of operating experience and investing experience kind of towards the upper half of this kind of chart of contractual recurring revenue, or at least kind of non-contractual recurring revenue, with occasionally looking more at repeat revenue businesses. And we could spend a whole amount of time talking about the benefits and drawbacks, but a long way of saying like recurring revenue is incredibly helpful when you're leading a business for a number of reasons. Number one, which being that it's a lot more predictable. It's a lot easier to model. And particularly as a first-time CEO in our world, it gives you more time and kind of vision and a little bit of defense to kind of understand what's going on. And it's easy to sometimes mistake repeat revenue for recurring revenue. Repeat revenue can be good. We bought a business personally with repeat revenue, and we thought it was recurring revenue. We didn't really understand that nuance. We quickly realized about a year in that repeat revenue is good, but it's not as good as true contracted recurring revenue. You have to resell your customers every year. It's predictable, but not quite as predictable. There's friction in the process. It kind of changes year to year a little bit. So all else equal, it's not bad. And we then spent the next 12 to 24 months of our leadership journey transitioning our business to be true contractual recurring revenue, which was a huge game changer. And generally speaking, all else equal, businesses towards the upper half of this chart are going to trade for higher prices. Yeah, we're not the only ones to think about recurring revenue. Most professional investors spend a lot of time on this topic. So I don't know, Larry, if you want to spend a little bit of time on revenue quality as well.
Yeah, I'm going to ditto exactly what you said, especially in terms of the valuation. I put what I look for, and if you notice A is reoccurring, that's the same as having the dental practice in your slide previously, right? At a minimum, I'm looking at reoccurring. The difference is reoccurring is not as predictable as recurring revenue, right? You definitely want the recurring model if you can find it, right? In manufacturing, distribution, those types of industries, you typically don't have recurring revenue, you typically have reoccurring revenue. So case in point, I have a manufacturing firm right now. It's a large company a large customer that I brought in during the due diligence phase when I acquired it. Thought I was doing something at that point, strategically, and it winded up being the gorilla. So they have a large percentage, in terms of customer concentration, they have a large percentage of our revenue stream. Now, they don't pay us recurringly, but they pay us reoccurringly. But it's almost predictable, but not as predictable as, let's say, maybe a SaaS model or something like that, right? I think if you look at payment terms from a practical standpoint in terms of the quality of revenue, if you have a business, typically customers are paying you on some type of terms schedule. And they're typically structured as 30, 60, 90 days. And so if you're a company and your customers are typically paying you 90 days, 120 days, like the old automotive suppliers used to get paid from some of the automotive companies, the valuation of your company can potentially suffer as a result of that. And what I found pretty interesting is there are some surprising links between revenue quality and profitability, overall profitability, looking at the growth potential of your business, looking at operational efficiency. And typically, if you have a high revenue quality in your organization, you're going to be able to reinvest. You're going to be able to attract funding, either from a banking standpoint, so that you can reinvest technology, infrastructure improvements, additional capital expenditures that you need to operate your business. And typically, the efficiency is born out of those types of investments. But then last, valuation and attractiveness. There's going to be different acquirers based on your business or based on the revenue attractiveness of your business, the quality of your revenue. Private equity is going to look for certain characteristics. Strategics are going to look for certain characteristics, and obviously financial buyers are going to look for that. But all of them want high revenue quality, and I would say that I put that almost at the very top of my list.
And for a little additional context, we'll share these slides after, as we have a little chart in here that helps you kind of piece through when you're looking at a business like, hey, where does this kind of fall on the spectrum of kind of revenue quality? It's sometimes it's a little more nuanced. It's just kind of a simple kind of chart that kind of walks you through that. The one thing that I will mention, though, it's easy to kind of assume, to look at revenue quality like in isolation. And there's an important kind of nuance to this as well. And there's like two sides to kind of revenue quality. Obviously, all else equal, we talked about in the previous chart, having, as we talked about here on the very top, having contractual recurring revenue is the best, all else equal. Now, if you told me that you had a contractual recurring revenue business, though, but half their customers leave every year, so it's contractual recurring, but there's a high amount of what we call churn in the business where, yes, it's contracts, it's visible, but half their customers leave every year, so you're basically starting from scratch. But on the other end, there's a repeat revenue business here that's maybe not quote unquote contractual recurring, but when you go in and you model the business and look at kind of the recurrence of that revenue, they haven't lost a customer in 30 years, right? So maybe it's not a contract, but if you look at the revenue that someone's producing every year, it's like clockwork. It's been, $100 a year for 20 years solid, or maybe growing at 5% a year. So all else equal, contractual recurring revenue is great, but you have to understand kind of retention. And there's different ways to think about retention. Again, could spend a whole class on this. But generally speaking, there's 3 major ways to think about it. Kind of like, are you keeping your customers? And we call that logo. Like, are the customer logos staying with you? Best in class businesses kind of in our world generally have like low single digit logo churn. So they're keeping maybe 95% plus of their customers every year. Gross revenue retention rate, in other words, like how much are those customers spending every year with you? So maybe you're keeping all the logos, but actually they spend less with you every year, which is, it's nice to keep them, but actually it's not quite as exciting as someone who's maybe spending more with you every year. And then this net revenue retention rate comes up a lot in software and more kind of B2B services businesses. And that's basically looking at, hey, for the customers that stay with you, you have some customers spending more, some customers leaving you, some customers spending less with you. When you net that all out kind of on a percentage basis, where are you at? And best in class kind of recurring revenue businesses will generally have a number that's over 100%. So even when you lose some customers, you have some customers reducing what you spend due to cross-sell or pricing or other things you do in your business, you're still on your existing customer base generating more than 100% of revenue from them the following year. Those are kind of like best in class kind of retention metrics we kind of see in our world. Now, again, you're not the only one thinking like that, so the businesses that hit those check boxes are going to be more desirable. But sometimes buried in all this data, like we talked about before, most businesses you're looking at aren't going to have these metrics readily available, or how they're calculating them is honestly probably wrong. So your ability to kind of dig in and discover this can be quite value add as well. Any additional kind of things you would think about maybe on that, Larry, or we can shift to industries as well?
Yeah, let's shift it.
Okay, great. Well, Larry, do you want to kick off on kind of how you think about industries? And I'm happy to add some context too.
Yeah. So in terms of what I thought, industries that searchers should find pretty attractive, from an industry perspective, you want to look at growth industries. You want to look at industries that are highly profitable. You want to look at industries that might be highly fragmented as well. High barriers to entry. Industries that have low cyclicality. I'm thinking of utilities, I'm thinking of health services type businesses, perhaps even a grocery store. You got to eat, right? I'm also thinking of low CapEx, exit multiples with very strong buyer interests. So I think that's the why. Why these types of, why would searchers find these particular types of, or these industries attractive? Under industry preferences, I've seen medical billing software companies extraordinarily profitable. You can also throw in the actual medical billing companies themselves, but the software provider typically has a very nice SaaS-related model. Niche manufacturing businesses that have scalability, that have long-term customer relationships, like you just mentioned, that have really good margins from a gross margin standpoint down to the cash flow margins as well. E-commerce related, specialty distributions. I love the SaaS model, and that seems to be an extremely profitable business model as well. Let me kind of go back to e-commerce. What I find interesting is when you look at the components of the P&L for e-commerce, it's kind of flipped versus what I would consider a normal type of business, like a manufacturing. In manufacturing or distribution, typical businesses that you would analyze, the largest spend is typically around their products, right? And then secondarily, you might see labor, right? So you got products, labor, then maybe facilities. For e-commerce, it's really marketing and advertising, right? That's what I have normally seen to be the large, more so than the product or the service that they're selling. So really being able to understand some of that, I think, is important. But e-commerce represents a very attractive space. And then obviously, PE has entered into this space from a large roll-up standpoint, the industrial maintenance or the home maintenance. In my manufacturing companies, we used to love our industrial maintenance companies to come in. If our equipment was down, we'd call someone, we can get back up and running. Because the cost of equipment being down could be $1 million a week It could be significant, right? Plus, you have lost labor and just the efficiency as it relates to that. So I think it works both ways. You have industrial maintenance, home maintenance, HVAC, plumbing, electrical. Those have been really hot as well. And then obviously healthcare services and other disrupting kind of technologies as well.
Well, that's super helpful context. And maybe I'll spend 2 minutes on kind of taking you back in time to kind of the industry we ultimately entered looked like back in 2011 when we initially acquired our business, RIA in a Box, just to add a little more kind of tactical kind of detail on what maybe you're looking for in an industry. And by the way, a lot of this is more in reflection. We weren't smart enough to know this at the time, and this was particularly good or bad. This is learned through experience and time. And I think one thing we realized is we were quite lucky. And so I don't want you to take this as, oh, we knew all this at the time. This is more as we've learned what kind of helped our journey. These are things that kind of stick out. So I'll highlight a few things. I'm not going to go line by line here. Again, we can share these slides. But ultimately, what we entered in 2011, and it's changed a lot since then, and these industries go through evolutions as they become more attractive and grow, is it was fragmented, it was off to the side. You couldn't find an industry report, and that's actually, I view, a positive with industries. It wasn't like you could Google and pull up the latest market share data or the latest industry analysis. It didn't exist. Like, this industry was too far off to the side. At the same time, talking to enough business owners in the space, we knew it was big enough. We didn't know how big, what total addressable market or TAM, maybe it was 30 million, maybe it was 100, maybe it was 200, but we knew it was big enough and these businesses were growing. We also knew there was an attractive greenfield opportunity. Like, most of the customers they were selling into didn't have an existing solution. Like, the people buying from them were buying from them from the first time. You weren't having to win, share from an entrenched competitor. These are people that were as greenfield sales opportunity, which we've now seen a lot of businesses is super, super helpful for growth. Our end customers were very healthy themselves, right? So it's really, really nice when the customers you're selling into are doing really well, right? When they're growing, they're super profitable, life's good. When you're a very small relative spend to them, and you may raise prices a little bit, but you're mission critical to what they do, they just don't care that much, right? But if you're selling into a customer that has really low margins, growth is declining, it's a tough industry, every dollar they spend, they're watching like a hawk, right? Because they have to, because it's a tough industry. So we are great beneficiaries of selling into a very healthy end client. And at the time, there was no private equity ownership in the industry, which I think sometimes you view that as negative, but that actually proved to be very positive. It was a bit early. It hadn't become overly efficient. It was mom and pop. It hadn't become a super efficient sales and marketing engine. Valuations were reasonable, because basically there was nothing big enough in the space for private equity to care about. And we ultimately were great beneficiaries of that over time. As the industry grew and our business grew, it then became right in the bullseye of many kind of private equity firms that ultimately led to like a lot of multiple expansion. We ultimately sold that business a few different times over time. So we were in there a little bit early. Now, what wasn't great is that we had small, medium-sized customers, so we're never going to have world-class retention. We had to get comfortable with that. We felt like there was enough growth in the industry of new firms being formed in our industry that was okay, but that was never going to be perfect. And we're in a regulatory business. Like, it was a bit spooky. Regulations could change. We ultimately got comfortable with that it wasn't as scary as we initially maybe thought it was. But there was always a little bit of regulatory overhang. So, long way of saying, this worked out well for us, but there is no perfect industry out there. Even though there are a lot of positives, there are definitely some negatives as well. And with that, Larry, we can open it up to a few questions here.
Yeah.
Do you think about going in the opportunity to grow through acquisition? Can you talk about growth through acquisition and what you look at in a company that it could potentially grow that way?
Yeah, absolutely. And that's one of the strategies that I employ right now in actually growing through acquisitions. I'm very acquisitive, if I could say that. So the things that I look for would be obviously a growing industry, a very profitable industry, a growth track record from the company itself, strong management team. There's a ton of aspects around that. I'm looking at what's the trajectory of this business, what's the potential scalability of this business, how difficult will it be for me to grow this business, how much growth CapEx do I need to grow this business as well. Because everybody now knows, I look for EBITDA after CapEx, right? So what's my real cash? And then, like I said earlier, is how do I enter into this business from a multiple standpoint, and then what's my potential exit strategy as well? So I'm looking at all of that with a heavy weight around, obviously, financial analytics and the management team. I don't want to operate the day-to-day functions of a business. I want to have a management team that's there. So can I work with that individual, or can I work with that team? How strong? What's their track record, et cetera, right? Or is it heavily reliant on the owner? Has the owner been driving the show? Is she really the key person that drives revenue? Is she the key negotiator in terms of contractual obligations with their customer base? There's a lot of different aspects. But I think from a generational wealth creation opportunity, ETA acquiring businesses or acquiring one company is definitely the way to go, because one company can, like the prior session, can really change your entire life, your entire family's life, if you're able to grow, acquire, grow, scale, obviously, and then sell that entity.
Yeah, and all I'd add just on kind of these, call it roll-up or multiple acquisition strategies, talking about that a little bit, just two things to consider. Where are you in that life cycle, that industry? Roll up, you want to be earlier, not late, to kind of like an industry kind of roll up strategy. Once it's kind of on the radar and everyone else has jumped in, ultimately those valuations we talked about start to climb, and it's much harder to kind of buy multiple businesses. And second, sometimes there's a reason why industries are fragmented. I think sometimes we all sit in our spreadsheet and say, hey, there's all these small businesses, why does that exist? Sometimes there's a reason why it's fragmented. You want to make sure there's a true reason to put these businesses together. Just because there's a lot of small businesses doesn't mean they should all be put together. Sometimes there's actually like an industry reason why that persists, and trying to fight uphill is going to be hard.
So you kind of answered part of my question right there with that, but you talked about looking at a business and looking at their management team and just checking their scalability and their EBITDA forecast. Well, say you're looking at a business that doesn't produce EBITDA forecast, one of those low market businesses. What are the telltale signs that you see early on that tell you this has growth potential? So I get the industry landscape itself, so that's helpful. But you kind of mentioned, the personnel. Are you looking more at, hey, does this business have the people with the ambition to make it grow, or is it more the mechanics of the business itself?
Both, actually. I'm looking at the industry, so the market dynamics. What's the trajectory of this market? Will it continue? If the market's CAGR, or compounded annual growth rate, has been 5 to 7% historically, if everything stays the same, I should expect for that market growth to continue at that same rate, right? So when I'm forecasting from a financial standpoint, I want to forecast in my base case what the CAGR has been over the last 2 to 3 years, right? But I'm also looking at what I can bring to the table if I have to hire an additional management team or an additional manager to come run that operation. What skill set, what unique characteristics they may bring to the table. Obviously, for me, I'm going to try to deep dive into someone who has that particular industry experience, because they have a network. They have an understanding of the ebbs and flows of that particular market, so they can bring some unique aspects or a unique skill set to run that business, and we can model that with the potential of their impact is going to be. But if there's a company that already has a management team in place, yes, I'm definitely going to be attracted to that, because they've been running that operation, and so I can see their impact. What gets a little gray is whether or not there's been significant influence from the owner, because a lot of times, this is not really just a transaction from the owner's standpoint. This is his identity. This is his life. This is his baby, essentially, that he's grown and developed for, it could be generations. And so what you don't want to do is ignore that and ignore their influence that will be pre-deal and also post-deal, and what that might do in terms of deal valuation and deal characteristics and your entire diligence phase as well. So I hope I answered that question.
Yeah, and all I'd add to that, we were very fortunate to have an early investor in our business, a gentleman named Will Thorndike, who some of you may be familiar with, has a great book called The Outsiders, and he's probably done more work on kind of small business acquisition and metrics. And he would argue, and I think we've seen it firsthand ourselves as investors, that the number one predictor of future growth is historical growth in these businesses. It's pretty dangerous to assume you're gonna all of a sudden accelerate growth. But if you were to actually model it out historically, he's probably invested in hundreds of these small businesses in our world. That by far is the number one predictor. Is like, was the business growing, before you acquired it? It tends to slow down, but that tends to persist. Very rarely, but on occasion, can you actually accelerate growth in the near term. Over many years, once you kind of get settled and things can change. But those first couple of years, that's usually the #1 predictor.
Yeah.
If we have time for maybe one more question, yeah. I know there's someone who said, I know you've had your hand up. Yep.
Oh, hey. Larry, wanted to dive in a little bit to a couple of things you said. That spectrum of repeat to reoccurring or recurring revenue. A couple examples stood out that I didn't fully understand. So e-commerce is one, and then you also talked here about you're potentially doing a brick and mortar retail deal. Both of those things feel, at least on the consumer side, more transactional. There's a lot less certainty around getting that customer to come back and buying something again. Some of it depends on what the product is being sold. But how do you look at those two examples? I'd be curious, because in my mind they don't feel as attractive as, of course, SaaS or dental or things like that.
Yeah, excellent question. So on the retail side, what I look also for is revenue quality, if there's been receivables or not. In this particular case, the company that I'm engaging with right now has no receivables. They deliver a product and they get paid for it. I like that. So I've kind of bypassed the whole risks around the receivable aspect. Plus, the historical growth rate and run rate of the business has been very predictable. And so even though you may not have a recurring situation, it's reoccurring revenues to the extent that there's a lot of attractiveness around that. And then you also have to look at the quality of earnings of that business as well. How profitable has that business, as well as how profitable can I make that business as well. In this particular instance, they've been running fairly manually, and I view that as a gold mine through technology adoption that I can implement within the operation. They don't track inventory, right? But they have a lot of it. They have like $2 million of inventory that I need to track, right? So I can reduce that inventory, and that's cash flow, right? And there's just a lot of aspects around a particular business. You can't just zone in on one and say, yeah, it doesn't necessarily have that reoccurring revenue. I like that factor, but here's some other mitigating factors. And maybe during your diligence, you can find other factors that are even more attractive than that, right? The SaaS model, it really depends on how you're going to structure that business. E-commerce, depending on your service, depending on what type. When I say e-commerce, I really mean online businesses, right? Not necessarily just the retail aspect of e-commerce, but online businesses. You can sell a ton of different options from a product standpoint to a service deliverable as well, and it really depends on how you structure that particular business. But regardless, the slide that you saw up there, recurring is definitely one of the most attractive aspects of business and industry, and then second to that would be reoccurring revenues.
With that, I think we probably should wrap up. And thank you, Larry, for sharing all your insights.
Thank you, GJ.
Really appreciate it. And thank you all for coming out today. And happy to stick around for more questions. Thank you.